Trading can make you rich fast. Investing can make you rich for life. But choosing the wrong one can cost you everything. Should you trade or invest? What's the real difference between the two? And why do so many people fail simply because they pick the wrong approach for their personality and goals? In this video, I'll break down the core differences between trading and investing, including risk, time commitment, mindset, and profit potential, so you can make the smarter choice. Have you ever jumped into the market without knowing whether you're supposed to trade daily or invest long-term? You're not alone. This confusion costs people money every day. By the end, you'll know exactly whether trading or investing suits you best, and how to build a strategy that actually aligns with your lifestyle and financial goals. At some point in every person's financial journey, a powerful question appears. Should I trade or should I invest? It sounds simple on the surface, but this single question has shaped fortunes, destroyed accounts, and defined financial destinies for decades. Some people swear by trading, calling it the fastest path to freedom. Others dismiss it as risky and unpredictable, placing all their faith in long-term investing. And somewhere in between, millions of people remain confused, jumping back and forth without clarity, direction, or results. This audiobook exists to bring clarity to that confusion, because trading and investing are not enemies. They are not rivals fighting for dominance. They are tools, fundamentally different tools, designed for different personalities, goals, time horizons, and emotional temperaments. Understanding the difference between them is not just financial education, it is self-discovery. Imagine standing at a crossroads. On one side is the road of trading, fast-moving, intense, demanding precision, discipline, and emotional control. On the other side is the road of investing, slower, steadier, built on patience, conviction, and long-term vision. Both roads can lead to wealth. Both roads can lead to ruin. The outcome depends not on the road itself, but on the traveler who chooses it. In the United States, the world's financial epicenter, this divide has existed for generations. Wall Street traders in New York execute thousands of transactions a day, extracting profit from short-term price movements. Meanwhile, long-term investors quietly build fortunes by holding shares of strong companies for decades, letting compounding do the heavy lifting. Both groups succeed and both groups fail, but for very different reasons. To truly understand trading versus investing, we must first dismantle a dangerous myth. One is superior to the other. This belief has misled countless beginners. Trading is not better than investing. Investing is not safer than trading. Each carries risk. Each requires skill. Each demands discipline. The real question is not which one is better, it is which one is better for you. Let's bring this to life with a real-world scenario. In 2009, after the global financial crisis, two friends, Michael and Aaron, found themselves at the same starting point. Both lived in California. Both had similar incomes. Both wanted financial independence. Michael chose investing. He began buying shares of strong U.S. companies, reinvesting dividends, and adding consistently during market downturns. Aaron chose trading. He studied charts, learned technical analysis, and focused on short-term price movements in stocks and later cryptocurrencies. Over the years, both built wealth, but in completely different ways. Michael's portfolio grew quietly. He rarely checked prices. He trusted time and fundamentals. Aaron's account grew in bursts. He experienced periods of rapid growth and periods of drawdown. Michael relied on patience. Aaron relied on precision. Neither approach was wrong, but each demanded a different mindset, lifestyle, and emotional structure. This is where most people go wrong. They choose trading because it looks exciting, without realizing it demands emotional resilience and strict discipline. Or they choose investing because it sounds safe, without realizing it requires patience, conviction, and the ability to ignore short-term fear. When people choose the wrong path for their personality, the market exposes them mercilessly. Trading is the art of capitalizing on time compression. Traders aim to make money faster by exploiting short-term inefficiencies, momentum, volatility, and human emotion. They operate in hours, days, or weeks. Their success depends on timing, execution, risk management, and psychological control. A trader must be comfortable being wrong often, exiting quickly, and acting decisively under pressure. Investing, on the other hand, is the art of time expansion. Investors allow time to do the work. They focus on business fundamentals, economic trends, innovation, and long-term growth. They operate in years or decades. Their success depends on patience, conviction, and the ability to withstand market cycles without emotional reaction. An investor must be comfortable watching short-term fluctuations without panicking. One is fast, one is slow, one demands constant engagement, one demands restraint, but both demand discipline. Another critical difference lies in how risk is perceived. Traders manage risk trade by trade. Losses are expected and controlled. A trader may take 10 losses in a row and remain calm because each loss is small and planned. Investors manage risk through diversification, valuation, and time. They may experience large temporary drawdowns but trust long-term recovery. A trader fears holding risk too long. An investor fears reacting too quickly. And here's a powerful truth many never consider. Trading and investing fail for opposite reasons. Traders fail because of emotional overreaction, fear, greed, impatience, and lack of discipline. Investors fail because of emotional capitulation, panic selling, loss of conviction, and abandoning long-term plans during market stress. Emotion is the enemy in both paths. It simply wears a different disguise. In the U.S. markets, history offers countless lessons. Traders who ignored risk during the dot-com bubble vanished when volatility exploded. Investors who panicked during the 2008 financial crisis sold at the bottom and missed the greatest bull market in history. The market rewards those who understand their role and punishes those who confuse it. This audiobook will not tell you to choose trading or investing blindly. Instead, it will guide you through the realities of both paths. The psychology, the mechanics, the risks, and the rewards, so you can make a conscious, informed decision. Or perhaps, as many successful professionals do, you may discover that the greatest power lies not in choosing one over the other, but in learning how to combine both intelligently. Because trading can generate cash flow, investing can build long-term wealth. Together they can create freedom. But before we go there, you must understand each path deeply. Not as a fantasy, not as a shortcut, but as a discipline. In the next chapter, we will dive fully into the world of trading. How traders think, how they operate, what they risk, and why so many fail while a few succeed consistently. You will step inside the trader's mindset and see whether this road aligns with who you truly are. To understand trading, you must step into the trader's world, a world defined by speed, uncertainty, and constant decision-making. Trading is not a passive activity. It is an active engagement with the market, where every movement matters and every decision carries weight. Traders operate in compressed time frames, often making decisions in minutes or hours that investors might take years to consider. This intensity is what attracts many people to trading, and it is also what destroys most of them. At its core, trading is about exploiting short-term price movement. Traders are not concerned with whether a company will dominate its industry in 10 years or whether an innovation will reshape the economy. They are focused on what price is likely to do next, today, tomorrow, or this week. Traders study charts, patterns, volume, momentum, and market psychology. They look for imbalances between buyers and sellers and attempt to profit from those imbalances before they disappear. This focus on the short term requires a very specific mindset. A trader must be comfortable with uncertainty. They must accept that no setup is guaranteed, that losses are inevitable, and that being wrong is part of the job. In fact, many successful traders are wrong more often than they are right. What separates them from failures is not accuracy, but discipline. A trader survives not by predicting perfectly, but by controlling risk relentlessly. In the United States, where markets like the NYSE and NASDAQ move trillions of dollars daily, professional traders operate with razor-sharp rules. They define risk before entering a trade. They know exactly where they will exit if they are wrong. They never allow a single trade to threaten their survival. For them, trading is a numbers game, a series of calculated bets where probabilities, not emotions, determine outcomes. Yet for beginners, trading often feels like an emotional roller coaster. One moment brings excitement and confidence as a trade moves in their favor. The next brings fear and panic when price pulls back. Without structure, this emotional volatility becomes unbearable. Many new traders exit winners too early out of fear and hold losers too long out of hope. The market punishes both behaviors mercilessly. Trading also demands intense self-awareness. Because decisions are frequent, a trader's psychological weaknesses surface quickly. Impatience leads to overtrading. Ego leads to refusing to accept losses. Fear leads to hesitation. Greed leads to oversized positions. The market acts like a mirror, reflecting every internal flaw back at the trader in the form of financial pain. This is why trading is often described as one of the most psychologically demanding professions in the world. Let's consider a realistic scenario. Imagine a trader in Chicago watching a stock open with strong momentum. The setup is clear. Volume confirms the move. The plan is defined. But as soon as the trader enters, the price pulls back slightly. Nothing has changed structurally, yet fear creeps in. The trader exits early, locking in a small loss. Minutes later, the stock resumes its move and reaches the original profit target. The analysis was correct. The execution failed. This is trading in its rawest form, not a test of intelligence, but a test of emotional control. Another defining feature of trading is frequency. Traders often take dozens or even hundreds of trades in a month. This repetition accelerates both learning and mistakes. A disciplined trader improves quickly because feedback is immediate. A careless trader collapses just as quickly because errors compound fast. Trading gives no mercy period. It rewards discipline swiftly and punishes recklessness immediately. Trading also requires time and focus. Even swing traders who hold positions for days or weeks must monitor markets regularly. Conditions can change rapidly. News can reverse trends instantly. Volatility can expand without warning. This makes trading demanding on lifestyle. It is not something you casually check once a week. It requires presence, preparation, and continuous learning. And yet, despite its difficulty, trading offers something powerful: cash flow. Traders can generate income without waiting years for compounding to take effect. They can profit in rising markets, falling markets, and even sideways conditions. For those who master it, trading becomes a flexible tool, one that can fund investments, support businesses, or create independence from traditional employment. But this power comes at a price. Trading is unforgiving to those who lack discipline. It magnifies emotional weaknesses. It exposes poor habits quickly, and it demands a level of mental resilience most people underestimate. This is why so many fail, not because trading doesn't work, but because it requires becoming someone different than who you were before. Trading is not about excitement. It is about control. It is not about prediction. It is about preparation. It is not about winning big. It is about losing small. In the next chapter, we will step away from speed and intensity and enter a very different world, the world of investing. You will see how investors think, why patience is their greatest weapon, and how time, not timing, becomes the most powerful force in wealth creation. To understand investing, you must slow down your thinking. You must step out of the noise, the flashing charts, the minute-by-minute price movements, and enter a world governed by patience, conviction, and long-term vision. Investing is not about reacting. It is about enduring. It is about trusting a process that unfolds over years, sometimes decades, while resisting the emotional storms that come with short-term market fluctuations. Where traders live in compressed time frames, investors live in expanded ones. They are not concerned with what price will do tomorrow morning. They care about where value will be 5, 10, or 20 years from now. Their focus is not price, it is value. Businesses, cash flows, innovation, economic growth, and long-term trends guide their decisions. Investors ask different questions. Instead of, where is price going next? They ask, is this asset worth owning for a long time? This difference in thinking creates a completely different psychological environment. Investors must develop patience to an almost uncomfortable degree. They must learn to sit through market corrections, economic recessions, political uncertainty, and negative headlines without reacting emotionally. Where traders exit quickly when wrong, investors often do the opposite. They stay invested through volatility, trusting that time will reward discipline. In the United States, some of the greatest fortunes in history were built through this mindset. Investors who bought strong companies during periods of fear, during recessions, crashes, and moments of widespread pessimism, and held them patiently through recovery cycles, saw compounding do extraordinary work. While traders were forced to make constant decisions, investors allowed time to work silently in their favor. But this silence is deceptive. Investing may look easy from the outside, but emotionally it is extremely demanding. Watching a portfolio drop 30 or 40% during a market crash tests conviction at a deep level. The investor's greatest enemy is not loss, it is panic. Many investors fail not because their investments were bad, but because they abandoned them at the worst possible moment. Let's bring this into a real scenario. In 2008, during the financial crisis, millions of investors watched the US stock market collapse. Fear dominated headlines. Banks were failing. Retirement accounts were shrinking rapidly. Two investors reacted very differently. One sold everything at the bottom. unable to handle the emotional pressure. The other continued investing steadily, buying quality assets at discounted prices. Over the next decade, the second investor saw extraordinary growth, while the first spent years trying to recover from emotional decisions made under fear. The difference was not intelligence, it was temperament. Investing demands faith in long-term progress, not blind faith, but informed conviction based on fundamentals. Investors must believe in economic growth, innovation, productivity, and human advancement. They must accept that short-term volatility is the price paid for long-term reward. Without this belief, investing becomes emotionally unbearable. Another defining feature of investing is simplicity. Successful investors often do very little. They buy strong assets, diversify intelligently, reinvest returns, and wait. There is no constant need to act. In fact, overactivity is often harmful. Every unnecessary action introduces emotion, cost, and error. For investors, doing less often produces more. This simplicity, however, is frequently misunderstood as passivity. In reality, investing requires discipline of a different kind. The discipline to not act when everyone else is panicking. The discipline to ignore daily noise. The discipline to stick to a plan when fear and greed are screaming for attention. That restraint is not weakness, it is strength. Investing also aligns naturally with compounding, one of the most powerful forces in finance. When returns are reinvested over long periods, growth accelerates in ways that feel almost unreal. This is why investors who start early and remain consistent often outperform those who chase faster gains later in life. Time, not effort, becomes the primary driver of success. Yet investing is not without risk. Poor asset selection, lack of diversification, overconfidence, and emotional attachment can destroy portfolios. Investors who believe that long-term means no risk often learn painful lessons. Long-term investing still requires education, discipline, and periodic review. It is not blind optimism, it is informed patience. Perhaps the most important distinction is this: trading requires frequent decision-making under pressure. Investing requires infrequent decision-making under emotional stress. Both are difficult. Both demand mastery. Both punish emotion. In the next chapter, we will bring these two worlds together and examine the core psychological differences between traders and investors. How their minds are wired, how they respond to fear and greed, and why choosing the wrong path for your personality often leads to failure. At the surface level, trading and investing look like financial strategies, but beneath the charts, balance sheets, and timeframes lies the real separator between success and failure: psychology. The market does not punish ignorance nearly as harshly as it punishes emotional mismatch. And this is where most people fail. Not because they choose the wrong strategy, but because they choose the wrong identity. Traders and investors operate under entirely different psychological pressures. What strengthens one can destroy the other. What feels natural to one can feel unbearable to the other. Understanding this psychological divide is essential because the market has a cruel way of exposing internal conflicts. If your personality does not match your approach, the market will eventually force the lesson, often through painful losses. Let's begin with the trader's psychological battlefield. Traders are exposed to frequent feedback. Every trade provides immediate results. This speed accelerates learning, but it also amplifies emotion. Fear, greed, impatience, and ego surface quickly. A trader must be comfortable being wrong often. Losses are routine. If a trader cannot emotionally detach from losses, trading becomes exhausting and destructive. Traders fail when they personalize outcomes, when a losing trade feels like a personal failure instead of a statistical event. Traders also struggle with overconfidence. After a series of wins, ego whispers dangerous lies. Risk increases, rules loosen, discipline fades. The market waits patiently and then delivers a correction that wipes out weeks or months of progress. Traders who fail psychologically believe they are smarter than the market. Traders who succeed respect the market's power and protect themselves relentlessly. Now consider the investor's psychological battlefield. Investors are tested not by speed, but by endurance. Their greatest enemy is not frequent loss, but prolonged uncertainty. Watching a portfolio decline slowly over months tests conviction deeply. Investors fail when they panic during downturns, sell at bottoms, or abandon long-term plans due to short-term fear. Unlike traders, investors may go long periods without clear feedback. That silence can breed doubt. Investors also struggle with complacency. Because investing feels calm, some investors stop reviewing fundamentals, ignore changing conditions, or hold on to poor assets out of emotional attachment. They confuse patience with stubbornness. Patience is discipline waiting. Stubbornness is refusing to adapt. The market punishes both traders and investors who confuse the two. Here is the critical insight. Traders fail from emotional overreaction. Investors fail from emotional capitulation. A trader reacts too quickly. An investor reacts too late. Both reactions are emotional. Both reactions are costly. Let's ground this in a real example. During the COVID market crash of 2020, traders who lacked discipline overtraded wildly, chasing volatility without structure, blowing accounts within days. Meanwhile, long-term investors who sold their portfolios in panic locked in massive losses, only to watch markets recover and surge to new highs within months. Same market, same crash, different psychological failures. The successful trader during that period was the one who followed risk rules, reduced position size, and traded selectively. The successful investor was the one who stayed invested, rebalanced calmly, and continued systematic investing. Both required discipline, but discipline expressed itself differently. This is why copying someone else's success is dangerous. A high-frequency trader's routine would emotionally exhaust a long-term investor. A buy-and-hold investor's patience would emotionally suffocate a day trader. Neither approach is superior. They are simply incompatible with the wrong personality. Ask yourself honestly, do you need frequent engagement to stay focused? Or does constant decision-making drain you? Do short-term losses motivate you to improve? Or do they emotionally disturb you? Does watching long-term drawdowns feel tolerable or unbearable? Do you crave action or stability? These questions matter more than any indicator or strategy. The market does not care about your preferences. It only reflects them. One of the most powerful realizations in finance is this: your personality is your greatest asset or your biggest liability. When you align your strategy with your temperament, everything becomes easier. Discipline strengthens, emotional noise quiets, decisions become clearer. When you fight your nature, every trade becomes a battle against yourself, and the market always wins that battle. This is why some people fail repeatedly in trading but thrive as investors, and why others fail in investing but succeed in trading. The difference is not intelligence, it is alignment. In the next chapter, we will move beyond comparison and explore something far more powerful: how trading and investing can work together instead of competing. Because the most resilient financial systems are not built on one approach alone, but on intelligent integration. For most people, the debate between trading and investing feels like a forced choice, as if you must commit to one path and reject the other entirely. But the most financially resilient individuals in the world, from US hedge fund managers to self-made millionaires, understand a deeper truth. Trading and investing are not mutually exclusive. When combined intelligently, they become extraordinarily powerful. This chapter is where the conversation evolves, where the false conflict dissolves, where you move beyond choosing sides and begin designing a system that works for your life, not against it. Trading and investing serve different purposes. Trading excels at generating cash flow. Investing excels at building long-term wealth. One feeds the present, the other secures the future. When used together with clarity and discipline, they create a financial ecosystem that is flexible, resilient, and scalable. Let's bring this idea to life. Imagine a professional in the United States earning a stable income, but aiming for financial freedom. They allocate a portion of their capital to long-term investing, buying quality stocks, index funds, or ETFs tied to U.S. economic growth. This portion is designed to compound quietly over decades, requiring minimal emotional involvement. At the same time, they allocate a separate portion of capital to trading, actively participating in short-term market movements to generate additional income. The trading profits are not spent recklessly. They are reinvested into long-term investments. This is not theory. This is how many successful individuals actually operate. Trading becomes the engine. Investing becomes the vault. The key is separation of purpose. Trading capital must be treated as risk capital, money allocated for short-term opportunity, strict risk control, and active management. Investing capital must be treated as ownership capital, money allocated for patience, compounding, and long-term conviction. When people mix these roles emotionally, problems arise. A common mistake is when someone trades with their investing mindset. They refuse to exit losing trades because they believe in the asset long-term. Losses grow, discipline disappears. Another mistake is investing with a trader's mindset, panicking during normal market corrections and selling quality assets too early. In both cases, the issue is not the strategy, it is confusion of intent. Clarity solves this. A hybrid approach demands clear rules. Trading positions have predefined entries, exits, and risk limits. Investing positions have long-term theses and review schedules. One is managed daily or weekly, the other is reviewed quarterly or annually. When each has its own identity, emotional conflict fades. This approach also creates psychological balance. Trading satisfies the need for engagement, progress, and feedback. Investing satisfies the need for stability, patience, and long-term security. Instead of fighting your nature, you give each part of yourself an appropriate outlet. This balance dramatically reduces emotional burnout, one of the most common reasons people abandon financial plans altogether. In the U.S. markets, this hybrid model has proven especially effective. Active traders often use profits to accumulate positions in long-term growth companies. Investors use dividends or long-term gains to fund trading education or controlled risk strategies. The two sides reinforce each other instead of competing. There is also a powerful risk advantage to this integration. When markets are volatile and short-term conditions are favorable, Trading can thrive even if long-term investments are temporarily stagnant. When markets are calm or trending slowly upward, investing compounds quietly even if trading opportunities are limited. You are never dependent on a single environment. This diversification of approach protects both capital and confidence. Another crucial benefit is time flexibility. Many people cannot or do not want to trade full-time. A hybrid system allows you to scale involvement based on life circumstances. During busy periods, investing carries the weight. During focused periods, trading adds acceleration. Financial progress continues regardless of how much time you can dedicate in a given season of life. But make no mistake, this approach only works with discipline. Without rules, hybrid strategies become chaos. Without clarity, people overtrade, oversize positions, and blur boundaries. The goal is not to do everything. The goal is to do each thing intentionally. Here is a defining principle. Trading accelerates wealth. Investing preserves and multiplies it. When combined wisely, you stop chasing money and start building systems. You stop reacting emotionally and start allocating strategically. You stop asking, should I trade or invest? And start asking, how do I design my financial life intelligently? This chapter marks a turning point. You are no longer a beginner choosing between options. You are becoming a strategist designing a framework. And now that you understand how trading and investing can complement each other, the next chapter will address one of the most practical and important questions of all: how to decide which approach deserves more focus at different stages of your life. Because the right balance at 25 is not the right balance at 45. One of the greatest mistakes people make with money is assuming that a single financial strategy should serve them for their entire life. Van K. Tharp's philosophy, when applied to the debate between trading and investing, reveals a far more nuanced truth. The right approach changes as your life changes. Markets evolve, responsibilities grow, priorities shift, and your financial strategy must adapt accordingly. What works brilliantly in one phase of life may be disastrous in another. Financial freedom is not built by rigid thinking. It is built by alignment. Alignment between your goals, your time, your emotional capacity, and your resources. Trading and investing are tools, and tools must be used at the right time, in the right way, for the right purpose. Early in life, time is your greatest asset, but capital is usually limited. Energy is high. Curiosity is strong. Mistakes are survivable. This is the phase where learning, experimentation, and skill building matter more than stability. For many people in this stage, trading becomes attractive, not because it is easy, but because it accelerates learning. Trading provides rapid feedback. It forces discipline. It exposes psychological weaknesses quickly. It teaches risk management in a way few other financial activities can. However, this stage is also where ego can cause the most damage. When capital is small, the temptation to take oversized risk is powerful. The desire to make it fast leads many to gamble instead of learn. The individuals who benefit most from trading early are not the ones chasing income, but the ones building skill, treating losses as tuition and discipline as the real reward. As life progresses, responsibilities increase, careers develop, families form, time becomes more limited, emotional bandwidth is no longer infinite. In this stage, investing begins to take on greater importance. Long-term investing aligns well with stability, consistency, and compounding. Instead of monitoring charts constantly, capital works quietly in the background. This does not mean trading disappears. It becomes more selective. more refined, more intentional. At this stage, many successful individuals shift their focus. Trading becomes a tool for opportunity and cash flow, not constant engagement. Investing becomes the foundation of long-term security. The mistake here is abandoning trading emotionally rather than strategically, or worse, clinging to aggressive trading styles that no longer fit lifestyle demands. Misalignment creates stress, and stress leads to poor decisions. Later in life, preservation becomes as important as growth. Capital is larger, losses feel heavier, emotional tolerance for volatility decreases. In this phase, investing often dominates. Capital protection, income generation, and stability take priority over acceleration. Trading, if present, is highly controlled and conservative. The goal is no longer to prove skill or chase returns. It is to sustain freedom and protect what has already been built. This progression is not a rule book, it is a framework. Some people thrive as traders well into later life. Others prefer investing early and never trade actively. The key is awareness. The market does not reward stubbornness, it rewards adaptability. Let's consider a realistic scenario. A person in their 20s trades actively, learning market behavior, building discipline, and developing emotional control. In their 30s, they allocate a larger portion of capital to investing, while continuing to trade selectively. In their 40s and beyond, they rely primarily on long-term investments, using trading only when conditions align perfectly. Each phase builds on the previous one. Skills are not wasted, they are repurposed. Problems arise when people lock themselves into identities. When someone says, "I am a trader," or "I am an investor," they limit flexibility. Identity rigidity is dangerous. The market changes, life changes. Freedom belongs to those who adapt. Another critical factor in choosing focus is time availability. Trading demands attention, investing demands patience. If your career or personal life prevents consistent market engagement, forcing yourself to trade will produce frustration and mistakes. If you have time, energy, and discipline, trading can be powerful. The wrong strategy in the wrong season creates unnecessary struggle. Emotional capacity also matters. Trading requires emotional resilience. Investing requires emotional restraint. If frequent losses disturb you deeply, trading may be emotionally costly. If prolonged drawdowns cause anxiety, investing may be challenging. Self-honesty here is not weakness, it is intelligence. This chapter reveals an important truth. Financial freedom is not about choosing the best strategy. It is about choosing the right strategy for who you are today and being willing to change tomorrow. Trading and investing are not static paths. They are dynamic tools. The most successful people are not those who cling to one approach forever, but those who evolve intelligently, aligning strategy with life. In the next chapter, we will address one of the most common and damaging traps people fall into when navigating these paths. The myths, illusions, and false promises that distort decision-making and keep people stuck. Understanding what not to believe is just as important as understanding what to do. If trading and investing were only about knowledge, far more people would be wealthy. The truth is harsher and more revealing. Most financial failure is not caused by lack of information, but by belief in myths. These myths sound logical. They feel comforting. They spread easily through social media, news headlines, and casual conversations. And slowly, quietly, they sabotage financial progress. Van K. Tharp's philosophy teaches that before you can succeed, You must first unlearn what most people believe about markets. One of the most damaging myths is the idea that there is a perfect strategy. People spend years searching for it. They jump from system to system, indicator to indicator, mentor to mentor, believing that somewhere out there exists a flawless method that never loses. This belief keeps people in permanent motion, but zero progress. The market does not reward perfection. It rewards consistency. Every strategy loses sometimes. Every system experiences drawdowns. The trader or investor who accepts this reality builds discipline. The one who rejects it stays trapped in disappointment. Another illusion is the belief that high returns must come quickly. This myth is especially destructive in trading. People see screenshots of massive profits and assume speed is normal. They forget survivorship bias. They don't see the thousands who lost quietly. They don't see the blown accounts, the emotional exhaustion, the years of discipline behind the few success stories. When speed becomes the goal, risk explodes. And when risk explodes, longevity disappears. Investors fall into a different version of the same trap, believing that long-term investing means no work or no risk. They assume buying and holding automatically leads to wealth, but long-term investing without education, diversification, or conviction becomes blind hope. When markets crash, hope collapses. True investing requires understanding what you own and why you own it. Patience without knowledge is not discipline. It is denial. There is also the myth that more activity equals more profit. Traders feel pressure to be constantly engaged. Investors feel pressure to constantly adjust portfolios. But in reality, overactivity destroys returns in both paths. Traders overtrade and rack up losses. Investors chase trends and sell at the wrong times. The market rewards selectivity, not busyness. Another dangerous belief is that emotions can be eliminated. People think successful traders feel nothing. Successful investors never worry. That is false. Emotions never disappear. They are part of being human. What changes is not emotion itself, but response. Professionals feel fear, greed, excitement, and doubt, but they do not let those emotions dictate behavior. Systems exist to protect decisions when emotions arise. Those without systems are controlled by emotion instead of guided by rules. Then there is the illusion of certainty. People want guarantees. They want confirmation. They want to feel safe before acting. But markets offer no certainty, only probability. Traders who wait for certainty enter too late. Investors who wait for certainty miss opportunity. Those who succeed learn to act with incomplete information, guided by logic, not comfort. A particularly harmful myth is that trading and investing are shortcuts to freedom. This belief attracts people who are already frustrated with work, money, or life. They bring desperation into the market. Desperation leads to poor decisions. The market senses urgency and punishes it. Trading and investing are not escape routes. They are skill paths. They demand patience before they reward freedom. Let's ground this in a real scenario. During a strong bull market, many people enter investing believing prices will only go up. They buy without understanding valuation. When a correction arrives, fear overwhelms them. They sell at the bottom. Later, when markets recover, they re-enter at higher prices. The myth of long-term always wins, without discipline, turns into repeated loss. At the same time, traders enter believing volatility guarantees profit. They ignore risk. They oversize positions. One unexpected move wipes out months of progress. The myth of fast money collapses under reality. Both failures come from illusion, not lack of opportunity. Tharp's work repeatedly returns to one core idea. The market is not difficult. People make it difficult by believing what is not true. When myths are removed, clarity emerges. When clarity emerges, discipline becomes easier. When discipline becomes consistent, progress accelerates. Breaking these illusions does not make trading or investing easy. It makes them real. And reality, while demanding, is fair. The market does not care who you are, where you come from, or what you believe. It only responds to behavior. The moment you stop chasing perfection, speed, certainty, and excitement, and start building systems, patience, and alignment, the game changes. You stop being manipulated by narratives. You stop reacting emotionally. You start operating intentionally. In the next chapter, we will move from myth-breaking to action, exploring how to build discipline that lasts, discipline that survives boredom, losses, fear, and temptation, because knowledge without discipline is powerless. Discipline is the quiet force behind every successful trader and investor. It does not announce itself. It does not create excitement. It does not feel glamorous. And yet, it is the single most important skill in the entire financial journey. Strategies change, markets evolve, tools improve, but discipline, real, unshakable discipline, is what carries people through every market cycle. Van K. Tharp makes it clear that without discipline, even the best knowledge collapses under pressure. Most people misunderstand discipline. They believe it is about willpower, about forcing yourself to do the right thing through sheer effort. But willpower is fragile. It fades when emotions rise. It disappears under stress. True discipline is not force. It is structure. It is the result of designing systems that make the right behavior easier than the wrong one. Discipline is not something you summon in the heat of the moment. It is something you build before the moment arrives. In trading, discipline means following your rules even when fear whispers to exit early. In investing, discipline means staying committed even when headlines scream disaster. In both cases, discipline protects you from yourself, because your greatest enemy in the market is not volatility, it is emotional reaction. Let's consider why discipline breaks down. Discipline collapses when rules are vague. It collapses when goals are unclear. It collapses when systems are incomplete. It collapses when identity is fragile. A trader without clear rules negotiates with emotions. An investor without conviction negotiates with fear. Negotiation always ends in compromise, and compromise in the market usually ends in loss. Van Tharp emphasizes that discipline emerges naturally when systems are well designed. When you know exactly what you are waiting for, you feel no pressure to act prematurely. When you know your risk is controlled, fear loses its power. When you trust your process, short-term outcomes stop mattering. Discipline is not heroic effort. It is calm execution. Let's bring this into a real-life example. A disciplined trader wakes up, reviews their plan, checks predefined conditions, and does nothing until the setup appears. They may go an entire day without taking a trade and feel completely comfortable doing so. An undisciplined trader feels restless. They need action. They interpret inactivity as failure. That need for stimulation leads to poor trades. Discipline also requires environment design. Your surroundings influence behavior more than motivation ever will. Professional traders structure their environment to reduce temptation. They limit screen time. They avoid constant news feeds. They set alerts instead of staring at charts. They journal consistently. They review weekly instead of reacting daily. These structures reduce emotional noise and reinforce discipline automatically. Investors do the same in different ways. They limit how often they check portfolio values. They avoid sensational financial media. They focus on fundamentals rather than daily price movement. They set rules for rebalancing instead of reacting to fear. Discipline becomes embedded in routine. Another powerful idea Tharp reinforces is identity-based discipline. When you identify as a disciplined trader or investor, behavior follows naturally. You stop asking, "Should I break my rules this time?" Because that behavior no longer fits who you believe you are. Identity is stronger than motivation. When discipline becomes part of your identity, it no longer feels restrictive, it feels natural. This is why habits matter more than intentions. Habits remove decision-making. And when decision-making is removed, emotional errors decrease dramatically. You no longer decide whether to follow rules, you simply follow them. Discipline also thrives on long-term perspective. People break discipline because they obsess over short-term outcomes. One loss feels devastating. One missed opportunity feels unbearable. But when you zoom out, individual events lose significance. What matters is trajectory. A disciplined person understands that progress is built over hundreds of decisions, not one dramatic moment. There is a quote that captures this perfectly. You don't rise to the level of your goals. You fall to the level of your systems. That applies to both trading and investing. Goals inspire, systems execute, discipline lives inside systems. And here is the truth most people never want to hear. Discipline is boring. It lacks drama. It offers no instant gratification. But boredom is a signal of mastery. When trading or investing feels boring, reminding you to simply follow rules, you are doing it right. Excitement is often a warning sign. It means emotion is driving behavior instead of logic. As discipline strengthens, something subtle but powerful happens. Confidence grows. Not confidence in outcomes, but confidence in yourself. You trust that you will do the right thing regardless of conditions. That self-trust is the foundation of financial freedom. Discipline does not make markets easier. It makes you stronger. Now that you understand how discipline is built and sustained, the final chapter will bring everything together. We will step back and look at the full picture: trading, investing, psychology, discipline, alignment, and answer the ultimate question. This is where everything comes together. After understanding the mechanics of trading, the patience of investing, the psychological divide between them, the myths that distort judgment, and the discipline required to survive long-term, we arrive at the most important realization of all. Financial success is not about choosing a strategy. It is about choosing an identity. Most people fail financially because they copy methods instead of building alignment. They follow what others are doing without asking whether it fits their temperament, lifestyle, emotional capacity, and long-term vision. They trade because it looks exciting. They invest because it sounds safe. But they never pause to ask the question that determines everything. Who am I? And how do I operate at my best? Trading and investing are not just financial activities. They are reflections of behavior. Trading rewards decisiveness, emotional control, and adaptability. Investing rewards patience, conviction, and long-term thinking. Neither is easier. Neither is superior. But one will feel natural to you, and the other will feel like constant resistance. The market is unforgiving to resistance. If you trade but hate frequent decisions, stress will erode discipline. If you invest but cannot tolerate drawdowns, fear will sabotage patience. The market does not adjust to you. You must adjust to the market by choosing the approach that fits who you are. In the United States, many of the most financially independent individuals do not label themselves strictly as traders or investors. They identify as capital managers. They understand their strengths and design systems accordingly. They allocate capital intentionally. They adjust over time. They evolve as life evolves. This flexibility is not confusion. It is maturity. Designing your financial identity means answering a few deep questions honestly. Do you thrive under pressure or under stability? Do you prefer active engagement or quiet consistency? Do you gain energy from fast feedback or from long-term progress? There is no right answer, only truthful ones. Once you answer honestly, clarity emerges. Decisions become simpler. Discipline strengthens. You stop forcing yourself into strategies that drain you. You stop chasing methods that impress others. You begin building a financial system that feels sustainable. One you can follow not just for months, but for decades. And here is the most powerful insight of all. Your financial identity is not permanent. Who you are at 25 is not who you are at 45. Time availability changes. Responsibilities grow. Emotional tolerance evolves. The most successful people give themselves permission to adapt. They don't cling to past identities. They refine them. They allow their financial strategy to mature alongside their life. This is why rigid thinking is so dangerous. When someone says, "I am only a trader," or "I will only invest," they limit growth. Markets change. Life changes. Freedom belongs to those who remain flexible without becoming reckless. The final truth is this: trading teaches control. Investing teaches patience. Discipline connects both. When you understand yourself, you stop asking which path is better. You start designing a system that serves your goals, your temperament, and your future. That system may include trading, investing, or both, but it will be intentional, structured, and aligned. And alignment changes everything. When strategy aligns with identity, discipline becomes natural. When discipline becomes natural, consistency follows. When consistency follows, wealth compounds. And when wealth compounds, freedom emerges quietly, without drama, without rush, without regret. This audiobook does not end with a command to trade or invest. It ends with an invitation to self-awareness, clarity, and intentional design. The market will always be there. Opportunities will always come and go. But your ability to choose wisely determines whether those opportunities build wealth or drain it. The greatest investment you will ever make is not in a stock, a trade, or a market. It is in understanding yourself. And once you do, trading and investing stop being confusing choices. They become tools in your hands, working together to build a life of control, confidence, and freedom. This is the final chapter for this audiobook, but it is not an ending. It is a moment of decision. Everything you have heard so far, the differences between trading and investing, the psychological demands, the myths, the discipline, the alignment with life stages, all of it leads to one unavoidable truth. Knowledge alone does nothing. Insight without action is comfort. Understanding without commitment is entertainment. Financial freedom begins only when clarity turns into deliberate behavior. At this point, you no longer lack information. You understand trading. You understand investing. You understand why people fail, why people succeed, and why copying others without self-awareness leads to frustration. What remains is something far more difficult than learning. Choosing a path, choosing an identity, choosing a system you will follow even when emotions rise, even when markets move against you, even when doubt whispers that quitting would be easier. The market does not reward curiosity, it rewards commitment. Many people spend their entire lives preparing. They read books, watch videos, listen to audiobooks, follow experts, and collect strategies, but never fully commit. They stay safely in the learning phase, mistaking motion for progress. But wealth is not built in preparation. It is built in execution. Imperfect execution beats perfect planning every time. This chapter is about crossing that invisible line, the line between knowing and doing. If you choose trading, you are choosing responsibility. You are choosing to face yourself daily. You are choosing structure, risk control, emotional discipline, and constant self-review. Trading will not tolerate excuses. It will expose impatience, ego, fear, and inconsistency quickly. But for those willing to master themselves, trading offers flexibility, cash flow, and accelerated growth. If you choose investing, you are choosing patience. You are choosing to trust long-term progress in a world addicted to short-term results. You are choosing conviction over reaction, simplicity over noise, and time over timing. Investing will test your ability to wait, to endure drawdowns, and to ignore fear-driven narratives. But for those who commit, investing offers compounding, stability, and quiet wealth. And if you choose a hybrid path, you are choosing intentional design. You are choosing to separate capital by purpose, to apply the right mindset to the right activity, and to build a financial system that adapts as your life evolves. This path demands clarity and discipline, but it also offers resilience. There is no wrong choice here. There is only an honest choice and a dishonest one. The dishonest choice is choosing what looks impressive instead of what fits you. The dishonest choice is chasing speed when you need stability. The dishonest choice is seeking comfort when you need discipline. The honest choice is quieter. It may not excite others, but it will sustain you. At some point after this audiobook ends, you will face a simple moment. You will open a chart, or review a portfolio, or consider placing a trade. In that moment, all theory disappears. What remains is behavior, and behavior is shaped by commitment, not motivation. Financial freedom is not built in 1 year. It is built in thousands of small, correct decisions, repeated consistently. You will make mistakes. That is guaranteed. You will experience losses. That is unavoidable. You will feel doubt. That is human. What matters is whether you respond with structure or with emotion, whether you follow your system or abandon it, whether you stay aligned or drift back into impulse. The market will test you, not once but endlessly, and each test will ask the same question. Will you act intentionally or react emotionally? The people who build wealth are not special. They are not smarter. They are not luckier. They are simply more consistent in doing unremarkable things correctly over long periods of time. They respect process. They honor discipline. They stay aligned with who they are. This audiobook was never meant to tell you what to do. It was meant to help you see clearly. Clarity removes confusion. Clarity removes excuses. Clarity leaves only choice. Now the responsibility shifts to you, not tomorrow, not someday. Now, choose your path, design your system, commit to discipline, and remember this final truth. Freedom is not found in the market, it is built through behavior. When your actions align with your identity, money becomes a tool, not a struggle. And when money becomes a tool, life opens in ways most people never experience. This chapter closes the audiobook, but the real journey, your journey, begins the moment you decide to act. Now you have the complete knowledge about trading and investing. But what if I tell you, having the knowledge of only trading or only investing will not guarantee success? Both these things involves understanding the basics of the stock market to support your trading or investing decisions. To get a complete understanding of the stock market and leverage this knowledge for your trading journey, click on the video popping up on the screen.